So now we looked at frictions on the employee side of the market. Let's get to the employer side of the market. So hiring employees is not costless. Okay, it costs money. So employers also face these frictions because they also need to hire employees, and that costs money. So some firms face costs related to how many workers hired instead of hours worked. So some employers have costs that they have to pay every time they hire somebody. These are called quasi-fixed costs. Now, these quasi-fixed costs can't be cut in the short run. Right? It's slow to adjust employment levels changing market conditions, so they just can't get rid of them. So there's two types of quasi-fixed costs. The first is labor investments. So cost of finding suitable employees, it's not free. So if employers want to find employees that best match what they're looking for, that costs money. They need to advertise, do screening, interviewing. Okay? This is all costs that they have to do. And then even after they hire, they have to they have to do an orientation with the new employee. There's also training costs. That can be explicit monetary costs. So they maybe have to send them to training that they have to pay for. Or it can be implicit opportunity costs to the trainer. So sometimes they have a supervisor training the employee. That supervisor is not doing work that's contributing to putting out whatever product they're doing. So that's more money. And there's also the implicit cost of the employee. Okay, the employee is getting trained while they're not producing. So all these costs, however, are investments. So why do employers spend money to hire and train the right employee? So that in the long run, they get the right person in there doing the best they can, being as efficient as they can, and that way they're going to make money from that employee. So if we look at training here, this is hours of training and this was from a study that was done in 1994. It's a little bit early. So this is a breakdown of training that employers give new employees. So they have formal instruction, 19 hours, hours spent by management and orientation, informal training, supervision, 59, coworkers in informal training, and then, kind of watching. So on average, it's about 153 hours. So almost 4 weeks of training that they have to do that they are not getting paid for. So the second type of quasi-fixed costs is employee benefits. So in addition to wages, people also get paid or also get compensation in some non-salary ways. So it can be medical and life insurance that they pay for, retirement plans, paid time off. Okay. These are all costs that the employer is going to pay without receiving benefits from it. So when it comes to deciding what to do with employment, businesses, companies, the employers, they need to figure out if they want to have more employees or have the employees work more hours. So there's two ways to do it. There's an employee hours trade-off. So if they have to have, let's just say, 40 hours of work done a week, they can either hire 2 employees part-time and have them do 20 hours a week, or 1 employee and have them do 40 hours. So in general, more workers means less hours for each worker, more part-time workers. But less workers means more hours for each. Now, what you're going to do is you're going to look at the marginal product labor, figure out how much each employee is going to bring you. And so if we look here, M is the number of workers hired, M is the number of workers hired, H is the average hours each worker is going to do. And so if you have the MPM, the marginal product of additional workers holding capital and hours constant, and MPH, the marginal product of additional workers or hours holding workers constant. So the easiest way to look at this is that when we talked about the amount of capital and the amount of labor to employ, we looked at that price marginal product ratio. And this is the same thing here. And actually this is a little bit. So you have the marginal expense of M, all right, which is employment, and the marginal expense of hours. So you want that ratio to be the same at the profit maximizing level. And this just goes back to what we were talking about previously. So let's talk about training now. So when you increase your training investment, you're increasing those quasi-fixed costs. All right, so again, these are the costs that the firms are doing that they're not going to be getting recouped for. So employers have training decisions when it comes to their new employees. Now, new employees must get trained. If the employer bears the cost, bears all the cost, okay, then what do they get out of it? Okay, they're doing all the costs, and the employee is just, reaping the benefits of it. So why would they do this? And they wouldn't. So they need to find some way to where, they bear some of the costs, the employee bears some of the costs. We're going to talk a little about that. Now, there's two conditions for an employer to invest in training for his employee. And those conditions are, first, it has to increase the marginal revenue product labor. An employer has to recoup any money it puts into training. In order to do that, the employee has to become more productive. And so the training has to increase the marginal revenue productivity of labor, meaning that the worker, hiring the worker is going to be, or training that worker is going to bring more money in. And the second condition is that the employee needs to stay with the employer long enough so they can collect those benefits from the training. Now, there's two types of training. There's general training and there's specific training. Now, general training is training that can be applied to any employer. Okay. So general training makes you more productive. It increases your marginal productivity for any employer that you may go to. And so, for example, this can be Excel training. It can be emotional intelligence training. It can be public speaking training. So where anywhere you go, you're more productive at any of those jobs because you get that training. So when this happens, if the employer gives general training, that employer is taking a risk. And they're taking a risk because they're doing this, making you more productive. And so you can go out and get a higher wage and say, look, I can do this. They paid for it, so you don't have to. Okay, so that's a risk. Now, specific training can only be used in the training employer's business. And so, for example, if you go to work for a company and they have a software that only they are using, okay, then training you in that, it's not going to make you productive anywhere else because it's specific to that job. Now, specific training is good because it makes the worker more productive, but only to that firm. To an outside firm, they're no more productive. So if you look at the training and post-training wage, this shows percentage increasing in productivity and wages over time. And so you see in profession. So you can see that in different professions where there is a certain amount of training, the productivity that's resulting from that is going to be higher in all these cases than the increases in wages that the employees are getting. And why? And this is showing the employees sharing in the costs. So if the employers are increasing wages less than the increase in the productivity, okay, then this difference is the benefits that the employer is getting. So that's them putting some of the costs onto the employee. So when it comes to, that's the training side. Let's talk about hiring investments now. So firms want to hire the best worker they can for what they're looking for. Because if they hire the wrong worker, that worker is going to be gone, and they're going to have to spend more money to go out and get another one, and so forth. They have to train them again, and so forth. So they need to make decisions on hiring as well. Now, firms want to get the best person in there. They want to get fast learners, somebody that can come in and learn the job and be good at it, and they can reap the rewards without a lot of training. Okay. Now, training costs are high, so they want to get that best worker in there so they don't have to incur those costs. Okay. So this is why employers do searches. This is why employers hire headhunters, or this is why they hire consultants to go out and find people, because they can't research everybody fully. There's only a limited amount that they can do to what they, to what people have. They can't go out and view them everywhere. So what they tend to do is they tend to rely on credentials and signals. Now, credentials is your past experience. It's what you've done, and it's a good gauge of, if you did that there, you can do it here, kind of thing. The other way that firms use hiring investments is by looking for what are called signals. Now, a signal is something that you do that tells somebody something about you. Okay? So, college education. People who graduate college, on average, get paid more than people who don't graduate college. Why is that? Is it that is that everyone who graduates college is better suited for a job than everyone who didn't? No, not necessarily. People may not go to college for specific reasons. But employers use college as a signal. Now, not as a signal that you have the knowledge for their specific job, but they use a signal that if you went to college and you graduated, that means that you are of high ability. Grades are a signal. Some people are terrible at tests. Does that mean necessarily that people who do well on tests and get good grades are going to be better in jobs than people who do poorly? No, not necessarily. But employers will look at that and say, okay, this person did good for grades. They work hard. Okay. Now, is that actually the case? No, but it's the best that they can do, given the information that they have. So they look at signals as a way to try to get, a good feel on the person, what they are capable of. The other way that firms can go about hiring that's a better way of getting a grasp on how productive an employee is going to be is by relying on an internal labor market. And that's hiring within, promoting within. Now, the positives there is that you're able to observe that person, so you know what you're getting from that person. And so we talk about, there's something called asymmetric information, where one party knows more than the other. Well, if the person is working internally, that asymmetric information is going to be low, because you're not going to have to observe as much, and because you're not going to have to go out and do as much research as you would, because you're able to see that person and get first-hand knowledge. Whereas somebody coming from outside, you're going to know less about. So these are just all ways that firms are able to cut back on some of those hiring costs. But in general, these are the frictions that are observed on the employer side that make it a costly process, and to where labor, that transaction is not free.